Howdy, Jacob here. Today we're looking at ESAB Corporation in the machinery industry, 7.8 billion market cap on 8.6 billion enterprise value. Their growth in revenue is very solid outside of a big decline from COVID of 13%. The last 3 years have been 24%, 7%, 7% year-over-year revenue growth, with gross margin in the mid-30s, operating margin in the low to mid-teens. And they've recently paid a dividend. Return on invested capital is upper single digits, probably right around their weighted average cost of capital. It looks like cost of goods sold is going to be the majority of their costs, which we saw from their gross margin being less than 50%. Balance sheet has 102 million cash on hand with 1 billion long-term debt, no short-term debt. So their long-term debt is quite a bit higher than their cash and cash equivalents on the balance sheet, but their free cash flow recently is about 300 million and is above 250 million. So it's less than 4 years of the free cash flow to pay off that long-term debt. And it looks like they went into debt for something right here. It just says other. So maybe an acquisition, maybe some assets that they purchased, and it looks like it was likely an acquisition. I don't see anything else on the balance sheet that would tell me it was anything different. And wait, that was 2022. Okay, yeah, I don't really see anywhere on the balance sheet what exactly that would be that they went into debt for. Just looked like it hit their shareholders' equity minus exactly what their long-term debt was. So that's kind of peculiar, but that'd be something I'd look into. If this looked like an obvious price at this point, I would definitely want to look more research at what is this. And it looks like it did increase their free cash flow, which is positive. Majority of their cash is going to acquisitions, and a little bit, that dividend is paying less than 10% of their free cash flow, so we're definitely not concerned with that. The yield is 0.2%, so it makes sense that it's not eating up a lot of their cash flow. We don't have a long history here, so we can't say exactly what they'll do for capital allocation purposes, but with this, I'm going to assume a lot of acquisitions and then debt pay down, or a little bit of debt pay down. So for assumption purposes, revenue growth, they're engaged in formulation, development, manufacturing, supply of consumable products. Probably, I mean, they've been around for quite some time here, but I think with some acquisitions, 6% seems pretty reasonable to me. With margins ranging from 8 to 10%, I feel pretty comfortable with that. Share change, shares have been relatively flat recently. Their stock-based compensation is about 19 million as of recently, and that's much less than 1% of their share market cap. So let's assume that they essentially just offset that 19 million, which is, using that's using about 5% of cash flow, free cash flow to do that. I think that's a reasonable assumption. Dividend, we don't have a long history of the dividends, so I can't really say that they're going to increase it very much. As for P, price free cash flow, I think I'm comfortable going with the market here. 15% return, and we're saying it needs to fall 73% before we get the return on 1 year. So to me, it's not so obviously cheap at this price that I really want to dig into it. There's too many other companies out there that I think are more appropriately priced for me to waste my time on something that needs to fall 73% based on my initial analysis of financial statement to say it's a buy. So hope you enjoyed the video. Great today.